Later CPA is the one you adore. Later CPA and Associates.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our new ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. So the topic this week is the business vehicle strategies, mileage versus actual, and documentation habits. I know all these titles sound really, really exciting. Not. They sound pretty boring, but the topics are exciting and the tax savings are exciting. So if you are using your car for your practice, the real strategy isn't picking the best deduction once. The strategy is picking the right method and building simple habits that make your deduction easy to defend. So the goal today, we want to know how the standard mileage method works versus the actual expense method, when each method tends to be better, and a dead simple deduction system that you can stick with. So why does this matter? Well, vehicle deductions are common, but they're also easy to mess up because people forget to track their mileage. People mix business and personal costs, and people don't know what counts as business driving. So the best deduction on paper is worth nothing if you can't substantiate it. So let's talk about the rules. The big rule: business mileage must be business mileage. So some business driving examples: driving to a second office location, driving to a training or a CE event, driving to meet with a vendor or a third party like a bank, the printer, or an office supply store. All of that is an example of business driving. Now, what is not business mileage? Commuting. That's always personal. Commuting is driving from your home to your main office or from your main office to home. Now, if you have a home office, that will qualify as your principal place of business, and that can change what trips count as business. But that's a specific setup. That needs to be done correctly. So you have two options for taking vehicle deductions. The first is the standard mileage method, the simple method. You will track your business miles and you'll multiply that by the IRS mileage rate. That changes each year. Now, you will still need to track your mileage. A mileage log is how you do that, and it's the best way. Record the date, where you went, the business purpose, and the miles you actually drove. You will also still need to track the total miles for the year, and that's so you can show the business percentage if it's needed. Now, the standard mileage method is great because it's clean and simple. It's great. It's amazing for high mileage drivers. And it's perfect for people who don't want to save every gas and oil change receipt. That's method A, the simple method, the standard method. Method B is the actual expense method. Now, this is the detailed method. This is what you may have heard about, and it's more involved than the simple standard method. So with the actual expense method, you are tracking the total vehicle's costs. That is the gas, the oil change, repairs, tires, insurance, registration, interest on the loan, etc., including the depreciation on the purchase of the vehicle. We'll talk about depreciation in a later topic, but that lets you basically claim the cost of the vehicle over a period of several years. And if you're leasing a vehicle, you can claim the leasing costs. Now, all of those expenses need to then be applied to the business use percentage of your vehicle to get the actual costs or the actual deduction you can take on your tax return. Now, you will need to collect the receipts and documents to support those expenses, and you will still need to track the business miles and the total miles. You use these miles to calculate the business use percentage. In effect, what you do is you take the total expenses for the car, you multiply that by whatever the business use of that vehicle is. If it's used 90% for business, based on the miles you drove, then those costs can be taken at a rate of 90%. If you're driving at 51%, then you can take 51% of those costs. Now, talk with a tax advisor if you want to use the actual expense method, because we can get into some sticky situations with that one. So talk with your advisor if you'd like to use that. Now, the actual method, that is great when you have an expensive vehicle or a vehicle that has a very high operating cost. Some of you know exactly what kind of vehicle that is. And this method is also really good for the low mileage drivers. Now you have to choose. You have to choose one of those methods. You cannot take both, either the standard mileage, the simple method, or the actual expense, the more detailed method. You have to pick one. So some questions to ask to help you decide: how many business miles are you driving? More miles often favors the mileage rate or the standard method. How expensive is your vehicle? That can favor the actual method. Are you willing to track all of those receipts? If that's a no, then pick the standard method. Then you don't have to worry about your receipts and tracking those. Or is this vehicle a mixed use? If it's heavily personal, you'll still need great tracking either way. So those are some questions to consider when you pick one of those two methods. Now, this is important. Pick the method you want to stick with permanently. You cannot pick the actual method in 1 year and then switch to the standard method in another year. That is not allowed. You can pick the standard method and then later switch to the actual method, but then you're stuck and you cannot change from the actual method. That is not allowed. So when you choose the actual method, you're stuck. When you're on the standard method, the simple mileage method, you can choose to be the actual method later, but then you're stuck again. So be intentional with your choice, especially when it's a new vehicle being brought into the business. Now, some documentation habits. This is where the strategy really comes into play. Your deduction lives or dies by two numbers: the business mileage and the total miles driven for the year. And also, it lives and dies by one sentence: the business purpose. Why was that trip a business trip? So there's 3 semi-audit proof methods to track those first, or to handle those. First, on the simple version, track your miles automatically. There's a number of apps out there that use the GPS and in the background will track your trips, and then later you just go through and categorize them on a regular basis, maybe weekly. Take a 2-minute review and just categorize all of the business trips and label them so you understand what they are later. Maybe it was for a client meeting. Maybe it was going to a CE training. Maybe it was just to deposit money at the bank. Whatever that would be. Monthly cleanup. Check this monthly. Reprint a report and use that. Now, if you're using the actual method, then you can also monthly upload the receipts. Or more often if you're using an app that lets you upload receipts like that. Now, a good mileage log, it contains 4 things: the date of the trip, the start and destination of the trip, the business purpose, and it can be simple. It can be 1 word, it can be 5 words, it can be 10 words, whatever, just so you know what the business purpose of that trip was. It records the miles driven. And that's it. That's a mileage log. You can keep it on a paper pad, or you can use one of the apps. Either way works fine. Now, there's some common mistakes you should avoid. Don't get in the mindset that you can estimate your miles at tax time. That is not the same as a mileage log. That will not hold up under audit. Second, thinking you only need to track the business miles, not the total mileage. That's where you need to correct that. Track both. Track the total mileage and the business mileage. That way you know what the business use percentage is if that's needed. On the tax return, both numbers are reported. Even if you're only doing the standard, the simple method, they'll report the business miles and the total miles, and it's easier to defend that in an audit if you have both. Don't get into the mindset that you can deduct 100% of the costs, but you definitely are using it personally. The car, I mean. That won't work. Make sure you're looking at the percentage, the split between business and personal. That's why we are tracking the mileage. Don't mix personal and business spending on the same card and account with no system. This goes way back to one of the basic strategies we've talked about a number of times in the past. Don't mix personal and business spending. If you have a business card that you're using to pay for gas and other vehicle expenses, continue with that. Don't suddenly start using your personal card midway through the year and expect your tax accountant to be happy about that. And stop calling commuting a business trip because you're self-employed. That's not how it works. Many of you listening maybe are self-employed, and that's great, but just driving to and from your office because you're self-employed, that doesn't automatically somehow make that a business trip. That's still commuting. Now, a couple quick examples for private practices. If you have 2 office locations, you can drive between those office locations. And in the same day, that's business. That's a business trip. Now, if you're driving to your main office from your home, that's commuting. Don't forget, we can't count commuting. Now, if you run errands for your practice between sessions, like running to the bank, going to the office supply store, that is business driving as well. Keep that in mind. Now, a couple closing thoughts. The decision between choosing the standard method versus the actual method, it comes down to being a math problem. And what are you willing to do to support the math problem? Documentation is a habit problem. Now, if you solve your habit problem, the tax strategy part, the math part, that becomes easy. Now, one critical thinking question to leave you with before we end. If you had to pick one habit you'll actually keep for the next 12 months, whether it's weekly trip reviews or monthly receipt cleanup, which one would make the biggest difference for you? Now, next week, we are talking about meals and entertainment. What's deductible and what isn't? So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Keep helping others to help themselves, and let us help you do just that. I'll see you next time.